For years, I believed my financial past was a life sentence. Then, I discovered the protocols that changed everything, not through generic advice, but through the documented, real-world cases we analyze. This is the mission of Credit Stories, to move beyond theory and into actionable strategy. What you are about to hear is a direct result of that work. It's a framework built from dissecting what actually works, and it begins with a fundamental truth they rarely tell you. Let me tell you something. Your bank, your credit card company, and even most self-proclaimed financial experts rely on you never fully comprehending. The common perception is that your credit score is a neutral, mathematical assessment of your financial responsibility, a fair judge of your character and habits. This is a profound and costly misunderstanding. The reality is that the modern consumer credit reporting system is, first and foremost, a commercial ecosystem. It is a highly profitable enterprise built on data aggregation, risk prediction, and monetization. The three major bureaus, Equifax, Experian, and TransUnion, are not public utilities or government agencies. They are publicly traded corporations. Their primary customers are not you, the consumer, but lenders, insurers, and employers who pay for access to your profile to inform their financial decisions. Therefore, every entry on your credit report, every 30-day delinquency, every high balance, every hard inquiry, every account placed in collections serves a dual function. On one level, it is a data point in an algorithm. On a more fundamental level, it is a marker that influences your profitability as a customer to the financial industry. A lower score does not merely signify risk. It justifies the imposition of higher interest rates, more fees, and less favorable terms. This is not a personal penalty, but a cold, economic recalibration of your perceived value as a revenue source. The psychological impact is not an accident, but an embedded feature. The opacity of the scoring models, the complexity of the dispute process, and the sheer emotional weight attached to that three-digit number are powerful deterrents. They cultivate a sense of helplessness and resignation. Many individuals come to accept their score as a fixed, immutable judgment on their past, rather than seeing it for what it truly is: a dynamic and often flawed data set that is subject to challenge, negotiation, and strategic correction. This learned helplessness is the system's greatest shield. It prevents people from asking the essential questions. Who verifies the information being reported? What are the legal obligations of the data furnisher? What constitutes a legitimate dispute under the Fair Credit Reporting Act? I spent years within the architecture of this system, not as a consumer advocate, but on the other side, analyzing risk, developing scoring methodologies, and understanding how data translates into financial outcomes. That perspective revealed a critical truth. The system's immense power is matched by its specific vulnerabilities. It operates on a framework of legal and procedural rules. To successfully navigate it, one must shift from a mindset of passive acceptance to one of strategic engagement. You must learn not just to participate in the game, but to understand its rulebook well enough to ensure it is being applied correctly in your case. What follows is not a simple list of tips for building credit over time. It is an operational guide to credit repair. We will examine the legal levers available to you, the systematic methods for auditing your reports, and the precise strategies for communicating with bureaus and creditors to correct errors and mitigate damage. This process requires diligence, patience, and meticulous documentation. It is not a magic solution, but a methodical approach to demanding accuracy and fairness within a system that often forgets the human being behind the data. The goal is to move from being a subject of your credit report to becoming its editor-in-chief. To effectively engage with the credit system, we must first dismantle the pervasive myths that perpetuate inaction and misunderstanding. These myths are often perpetuated by well-meaning but outdated advice, creating unnecessary obstacles for individuals seeking to improve their financial standing. The first and perhaps most persistent myth is that checking your own credit score will harm it. This is a fundamental confusion between two distinct types of inquiries: a soft inquiry, which includes your own requests for your report, A pre-approval process initiated by a lender or a background check by an employer has no impact on your credit score. It is merely a review. A hard inquiry, which occurs when you formally apply for new credit, such as a loan or credit card, can typically lower your score by a few points temporarily. The critical distinction is authorization. You initiate a hard inquiry by applying for credit, while soft inquiries do not require your explicit permission for every instance. Regular monitoring of your own report through annualcreditreport.com or other legitimate services is not only harmless, but is the essential first step toward responsible management. The second damaging myth is the belief that closing old or unused credit card accounts is a beneficial way to simplify your finances and improve your score. In reality, this action can negatively impact two major components of the FICO scoring model: your credit utilization ratio and your average account age. Your utilization ratio, the amount of credit you are using versus your total available credit, is a significant factor. Closing an account with a high credit limit immediately reduces your total available credit, which can cause your utilization percentage to spike, thereby lowering your score. Furthermore, credit scoring models consider the age of your oldest account and the average age of all accounts. Closing a long-held account can shorten your credit history, making you appear less experienced to the algorithm. A more strategic approach is to keep these accounts open, use them minimally to prevent inactivity closures, and pay the balances in full each month. The third and most financially detrimental myth is the idea that you must carry a small credit card balance from month to month to build credit. This is unequivocally false. The belief that interest payments are required to demonstrate creditworthiness is a costly fallacy. Credit bureaus report your statement balance to the scoring models. You can and should pay your statement balance in full by the due date. This demonstrates responsible usage without incurring interest charges. Carrying a balance does not improve your score. It only enriches the lender through interest fees. The goal is to show active, responsible use of credit, not indebtedness. With these misconceptions clarified, we can now construct a proactive framework for credit repair, which I term the strategic trifecta. This is not a passive waiting game, but a concurrent three-pronged offensive. Pillar 1 is the forensic audit. This moves beyond simply glancing at a credit score. It involves obtaining your full reports from all three major bureaus, Equifax, Experian, and TransUnion, and conducting a line-by-line analysis. You are looking for inaccuracies, accounts that are not yours, late payments that were made on time, balances that are incorrect, accounts listed multiple times, or negative items that have exceeded the legal reporting period, typically 7 years. Discrepancies between the three reports are also a major red flag. This audit forms the evidentiary basis for all subsequent actions. Pillar 2 is the systematic dispute engine. Once discrepancies are identified, you must formally challenge them. This involves drafting precise, written disputes to both the credit bureau reporting the error and the original data furnisher, the lender or collection agency. The dispute must be clear, factual, and include copies of supporting documentation. It is critical to understand the legal obligation under the Fair Credit Reporting Act. The Bureau must conduct a reasonable investigation, typically within 30 days. If the furnisher cannot verify the information, it must be deleted. This process is the primary mechanism for correcting the factual record. Pillar 3 is leveraged negotiation. For items that are verified as accurate but are harming your profile, such as legitimate collections or charged-off accounts, strategic negotiation is your tool. This involves communicating with creditors or collectors from a position of informed resolve, not desperation. Techniques include negotiating pay-for-delete agreements, where the collector agrees to remove the negative item in exchange for payment, or settling a debt for a lump sum that is less than the full amount owed. These negotiations require clear communication, written confirmation of terms before payment, and a firm understanding of your rights under laws like the Fair Debt Collection Practices Act. This trifecta, audit, dispute, negotiate, operates as an integrated strategy. You are not waiting for items to age off your report. You are actively challenging inaccuracies and negotiating the resolution of valid liabilities on terms that mitigate damage to your financial profile. It is a shift from passivity to procedural and strategic action. Having established the strategic trifecta, we now move to its advanced application, focusing on the legal and procedural leverage points that can compel change. This is where understanding transitions into actionable power. The foundation of this power rests not on secret tricks, but on the statutory rights codified in federal law, primarily the Fair Credit Reporting Act, FCRA, and the Fair Debt Collection Practices Act, FDCPA. The FCRA establishes that the information on your credit report must be accurate, fair, and substantiated. It grants you the right to dispute inaccurate information and imposes a legal obligation on both the credit bureau and the original data furnisher, the lender or collection agency, to conduct a reasonable investigation upon receipt of your dispute. The critical nuance often overlooked is the standard of verification. The furnisher cannot simply confirm that the data in their system matches what they reported. They must, upon your specific challenge, verify the underlying validity of the debt or the reported delinquency. This might involve producing the original signed account agreement or a full payment history. If they cannot conclusively verify the item within the statutory timeframe, the Bureau is required to delete it. This leads to the concept of procedural leverage. Every player in this ecosystem, the Bureau, the bank, the debt collector, must operate within a complex web of compliance rules. A minor procedural misstep on their part can become a significant point of leverage for you. For example, a debt collector is required under the FDCPA to provide, within 5 days of initial contact, a written validation notice detailing the amount of the debt and the name of the original creditor. Failure to provide this is a violation. More advanced is the strategy of invoking arbitration clauses found in many original credit agreements. While these clauses are often seen as favoring corporations, they can be used strategically by a consumer to force a creditor into a potentially costly and lengthy private dispute resolution process, making a simple deletion or favorable settlement a more attractive option for them. To illustrate the potential velocity of this approach, consider the case of a former client, whom we will refer to as James. When he first engaged, his financial profile was, by conventional standards, catastrophic. He presented with approximately $95,000 in combined credit card and medical debt spread across 11 accounts, most of which were in various stages of collections or charge-off. His FICO score was 514, placing him in the very poor category and effectively locking him out of mainstream financial products. He was facing wage garnishment and had resigned himself to the permanent stigma of bankruptcy. We initiated the trifecta framework with intense focus. The forensic audit revealed multiple inaccuracies, 2 accounts he did not recognize, 3 late payments that were incorrectly dated, and 1 collection account that had surpassed the 7-year reporting period. The systematic dispute engine was deployed against these items immediately. Simultaneously, for the remaining valid but damaging accounts, we commenced leveraged negotiation. This involved carefully drafted settlement offers sent via certified mail that included 2 key elements: a low lump sum settlement offer, often 25 to 35% of the balance, and a stipulated condition for a pay-for-delete agreement. We referenced specific account numbers, cited the relevant provisions of the FCRA regarding accurate reporting, and maintained a tone of unemotional, factual resolution. The result was not instantaneous, but it was methodical. Within 90 days, 9 of the 11 negative items were removed from his reports, the 5 inaccurate ones via successful disputes, and 4 others via negotiated settlements with deletion agreements secured in writing prior to payment. The remaining 2 accounts were settled for a combined total of approximately $32,000, a fraction of the original debt. The subsequent impact on his credit score was dramatic. With the majority of negative items purged and his overall utilization ratio radically improved by the resolved debts, his FICO score rose to 682 within that same quarter. This did not make him a prime borrower overnight, but it was a transition from financial exile to the threshold of eligibility. Within 6 months, he was approved for a secured credit card to begin rebuilding positive history, and the path to a conventional auto or mortgage loan, once a fantasy, became a realistic medium-term goal. It is imperative to state clearly that this path requires scrupulous adherence to the law and ethical conduct. The objective is not to fabricate disputes or evade legitimate obligations. It is to ensure that the reporting of your financial history is precise, complete, and compliant with the law. You are exercising your legal rights to accuracy and fairness. The system is designed to respond to precise, knowledgeable, and persistent pressure applied at its specific points of obligation. James's story is not one of magic, but of methodology. Replacing hope with a structured process grounded in the system's own rules. With the strategic principles and legal levers established, we now transition to implementation. Knowledge without execution is merely theory. Therefore, we will outline a structured 90-day operational blueprint. This is not a passive timeline, but an aggressive campaign schedule designed to create momentum and compound results through concurrent action. Phase 1, weeks 1 to 2. The intelligence gathering and foundation phase. This initial stage is dedicated to preparation and organization, which are critical for success. Day 1. Immediately request your complete credit reports from all 3 major bureaus via annualcreditreport.com. This is your foundational data set. Week 1. Conduct the forensic audit. Create a master document. A spreadsheet is ideal, with columns for creditor name, account number, reported balance, status, date of first delinquency, and any inaccuracies noted. Categorize each negative item. Column A for clear inaccuracies, wrong account, wrong date, expired. Column B for items potentially vulnerable to procedural challenge. And column C for valid verifiable debts. Week 2. Assemble your documentation toolkit. This includes copies of your driver's license, a recent utility bill for proof of address, and any relevant payment records, cancellation notices, or previous correspondence related to the accounts in question. Establish a dedicated communication log to record every call with date, time, and representative's name, and all sent correspondence using certified mail with return receipt requested. Phase 2, weeks 3 to 6, the dispute and initial engagement phase. This is the first active offensive, targeting the factual integrity of your report. Weeks 3 to 4, draft and send your first round of dispute letters. For every item in column A, clear inaccuracies, send a separate, concise, and factual dispute letter to both the credit bureau reporting it and the data furnisher. The letter should clearly identify the item, state the specific reason for the dispute, e.g., not my account, payment was made on time, this debt is past the 7-year reporting period, and include copies, not originals, of your supporting documents. Mail everything via certified mail. Weeks 5 to 6. Monitor your mail and online credit report portals for responses. The bureaus have 30 to 45 days typically to complete their investigation. Log all responses. Begin preliminary research on the collectors or creditors holding the debts in columns B and C, understanding their typical settlement practices. Phase 3, weeks 7 to 10, the negotiation and resolution phase. While disputes are being processed, you engage with the remaining valid debts from a position of strategic strength. Weeks 7-8, for accounts in column B, procedural challenges, and column C, valid debts, initiate contact with a written settlement offer. This letter should be brief and businesslike. State your willingness to settle the account in exchange for 2 conditions. First, a lump sum payment at a significantly reduced percentage, e.g., 30 to 50% of the balance. And second, the removal of the negative entry from your credit report upon payment, a pay for delete. Emphasize that any agreement must be provided in writing before any payment is transmitted. Weeks 9 to 10, negotiate. Be prepared for counteroffers. Your leverage is the certainty of a lump sum payment versus the uncertainty of continued collection efforts. Do not agree to anything over the phone without written confirmation. If a collector refuses a pay for delete but offers a low settlement, weigh the financial benefit of paying less against the credit report impact of a paid collection versus an unpaid collection. Phase 4, weeks 11 to 12, the consolidation and rebuilding foundation phase. This phase is about solidifying gains and initiating positive momentum. Week 11, review and update your master document. Note all deletions from successful disputes and settlements. For any unresolved disputes where the Bureau verified the item, consider a follow-up dispute with new information or a direct challenge to the furnisher's verification method. Week 12. Begin the active rebuilding of your credit profile. If you do not have any open positive accounts, research and apply for a secured credit card from a reputable institution that reports to all three bureaus. If you have a positive existing account, ensure utilization is kept below 10% of the limit. Set up automatic payments for all accounts. This marks the transition from a pure repair mindset to a growth mindset. However, this mechanical blueprint will falter without addressing the most significant obstacle, the internal psychological narrative. The shame and anxiety associated with debt are powerful saboteurs. It is essential to cognitively reframe this undertaking. You are not a supplicant begging for mercy from a moral authority. You are a principal engaging in a business and legal process with counterparties. Large financial institutions negotiate settlements and dispute liabilities as a standard course of business. You are merely adopting the same pragmatic approach for your personal economy. View this process as a systematic project management exercise, not a reflection of personal worth. Each dispute letter is a project deliverable. Each negotiation is a business meeting. Each deleted item is a milestone achieved. This dispassionate procedural perspective is your psychological armor. It allows you to persist through form letters, denial responses, and difficult conversations because you are following a plan rooted in law and strategy, not emotion. The goal is to reclaim the narrative of your financial identity, not from a place of guilt, but from a position of competent and determined agency. We have traversed the conceptual landscape of the credit system, dismantled its pervasive myths, and equipped ourselves with a strategic framework and a tactical blueprint for engagement. To conclude, we must crystallize the core philosophy that animates this entire endeavor, for without it, the mechanics are merely a checklist. Your credit score is a numerical abstraction, an algorithmic output generated by proprietary models. It is data. However, the financial opportunities it gates, home ownership, reliable transportation, affordable insurance, even certain employment paths, are profoundly real. The fundamental shift advocated here is a refusal to conflate the two. You are not your credit score. You are an individual with legal rights, the capacity for strategic action, and the ability to systematically challenge and correct the record of your financial transactions. The process outlined is not a guarantee of a perfect score, nor is it a shortcut to absolving legitimate financial responsibilities. It is a methodology for ensuring accuracy and advocating for fairness within a system that is often impersonal and error-prone. It replaces passive hope with procedural action. The 90-day blueprint, the trifecta framework, the emphasis on documentation. These are the tools for translating the theoretical rights granted by statutes like the FCRA and FDCPA into tangible, report-altering outcomes. This journey from being a subject of your credit report to becoming its authorized editor is perhaps the most empowering financial transition you can undertake. It moves you from a reactive position at the mercy of reported data to a proactive stance, auditing and shaping that data with informed precision. The confidence gained from successfully navigating this process often extends beyond credit repair, fostering a more assertive and literate approach to personal finance as a whole. The information presented in this discussion provides the foundational principles and initial direction. However, the landscape of credit is dynamic, with evolving regulations, creditor tactics, and specific case complexities that cannot be fully addressed in a single narrative. For ongoing education, detailed case studies, template letters, and analysis of advanced strategies, I invite you to continue this exploration on our dedicated platform, Credit Stories. On the channel, we deconstruct real-world scenarios, interview professionals who navigate these systems daily, and provide continuous updates on effective methods. We examine the nuances that make the difference between a generic dispute and a successful challenge. If you are committed to taking definitive control of your financial narrative, I strongly encourage you to subscribe to the Credit Stories channel. By subscribing, you gain access to a structured library of actionable content designed to guide you through each step of this process. Ensure you activate notifications so you do not miss our subsequent installments, where we will delve into specific topics such as crafting the most effective dispute language, negotiating with particularly recalcitrant collectors, and legally leveraging common reporting errors to your advantage. Begin today. Obtain your reports, initiate your audit, and take the first step out of passivity. Remember, in the architecture of your financial life, you are not merely a tenant. You have the right and the tools to be the architect. Thank you.